Good evening. Thank you for joining me.
The S&P 500 just hit a new all-time high above $7,000. Consumer sentiment just hit a new all-time low, 47.6, the lowest reading in the University of Michigan survey's 74-year history. Read that again. Stocks at their highest point ever. The people who own those stocks, the most pessimistic they have ever been measured. That is not a healthy market. That is a market running on one engine while the other is on fire. The headlines will tell you the rally is real. The ceasefire is coming. The worst is over. But underneath the surface, a mechanism is forming. One that has triggered the most devastating stock market collapses of the last century. It has nothing to do with earnings. It has nothing to do with sentiment recovering. It has everything to do with oil, debt math, and a Federal Reserve that has no clean move left on the board. By the end of this breakdown, you will see the three signals, all publicly trackable, that will tell you whether what comes next is a rally or a reckoning. Stay for those signals. They are already flashing. The confusion is understandable. The market is doing exactly what it always does during the most dangerous phase of a structural dislocation. It rallies on hope. Between April 7 and April 17, 2026, the S&P 500 surged roughly 10% from its late March low. The Nasdaq posted its longest winning streak since 2009, 12 consecutive positive sessions. Retail buying activity jumped from the 10th percentile to the 55th percentile in just days, according to J.P. Morgan client flow data. The narrative snapped into place. Ceasefire imminent, oil coming down, crisis over. But here is what the news is not showing you. Think of this market like an iceberg. The visible tip is the price. Green candles, new highs, relief. The submerged mass, the part that actually determines whether the iceberg holds or capsizes, is the structural damage accumulating beneath. And that damage has three layers. The Strait of Hormuz, through which 20% of the world's seaborne oil and 20% of its liquefied natural gas normally flows, has been functionally closed or severely restricted since February 28, 2026. The U.S. Energy Information Administration reported that Brent crude began the year at $61 per barrel. It hit $118 per barrel by the end of March. That is the largest quarterly price increase on an inflation-adjusted basis in data going back to 1988. The price you see on your stock app is the surface. The oil shock underneath it, the debt math compounding behind it, and the institutional repositioning happening because of it, that is the mechanism. And it does not care about ceasefire headlines. On February 28, 2026, the United States and Israel launched coordinated airstrikes against Iran, targeting military sites, government infrastructure, and killing Supreme Leader Ali Khamenei. Within hours, Iran retaliated with missile and drone strikes across the region and effectively shut down the Strait of Hormuz. The numbers that followed are staggering. Before the war, roughly 20 million barrels of oil and refined products moved through the strait every single day. After the closure, that volume dropped to near zero for extended periods. Between March 1 and March 15th, maritime tracking data showed approximately 90 total vessels passed through the strait, down from a pre-war norm of 100 to 135 vessels per day. Saudi Arabia, Iraq, and the UAE shut in production. Oil prices surged. By mid-March, Brent crude surpassed $100 per barrel. By March 31st, the Brent WTI spread hit $25 per barrel, the highest in over 5 years, according to the EIA. Retail gasoline in the U.S. reached $3.99 per gallon by March 30th. Diesel climbed to $5.40 per gallon. Think of the Strait of Hormuz as a single artery feeding blood to the global economy. When it was open, nobody thought about it. Now that it is clamped, every organ is feeling the pressure. This is not a pipeline reroute. This is not a sanctions workaround. This is a physical choke point that cannot be bypassed. Roughly 80% of Asia's oil imports transit that strait. And here is the part the ceasefire headlines ignore. As of today, April 20th, 2026, the strait is still not fully open. Iran reopened it briefly on April 17th, then closed it again on April 18th, after the U.S. refused to lift its naval blockade of Iranian ports. The U.S. Navy has seized an Iranian cargo ship. Iran has fired on vessels attempting passage. 23 ships have been forced to turn around by U.S. forces enforcing the blockade. The ceasefire, brokered by Pakistan on April 7th, expires on April 22nd, 2 days from today. And the negotiations in Islamabad have produced no agreement. The oil is still not flowing, but the stock market is at an all-time high. That disconnect is not a sign of strength. It is a signature of what comes before structural repricing. Now look at what the institutions are actually doing, not what they are saying. The Federal Reserve held its benchmark rate at 3.5% to 3.75% at its March meeting. The vote was 11-1 to hold. The lone dissenter, Governor Stephen Miron, wanted a cut. Chair Jerome Powell stated the current rate is a good place to sit, but the Fed is trapped. Here is why. Year-ahead inflation expectations surged to 4.8% in April, according to the University of Michigan, up a full percentage point from March in the largest one-month jump the survey has recorded. Core inflation was already running above the Fed's 2% target before the oil shock. The EIA forecasts Brent crude to average $115 per barrel in Q2 2026, nearly double where it was in January. That means cutting rates fuels inflation. But holding rates squeezes an economy that is already cracking. The CBO projects federal net interest payments will exceed $1 trillion in fiscal year 2026, nearly triple the $345 billion paid in 2020. The national debt crossed $39 trillion in March 2026, growing at a rate of roughly $7.2 billion per day. The chess king has no clean squares left. Every direction the Fed moves, something breaks. If it cuts, oil-driven inflation accelerates. If it holds, the cost of servicing $39 trillion in debt at 3.5% continues to consume the federal budget. If it raises, and by late March, futures markets briefly priced in a 52% probability of a rate hike by year-end, per the CME FedWatch tool, it risks tipping the economy into recession while consumers are already at record low confidence. Meanwhile, central banks globally are repositioning. The World Gold Council forecasts central banks will purchase roughly 850 tons of gold in 2026. China has reported 16 consecutive months of net additions to its official gold reserves, reaching an all-time high of approximately 2,309 tons. Poland, Kazakhstan, and a growing number of African central banks are buying. But here is the institutional contradiction. While central banks have been accumulating gold, some are now being forced to sell. Russia has been liquidating gold to fund its war in Ukraine. Turkey is considering borrowing against its reserves to defend the lira. The war-driven oil shock is forcing nations that desperately need reserves to spend the very reserves they have been building. The official narrative says the crisis is temporary. The institutional money is behaving as if it is structural. Central banks do not buy 850 tons of gold in a year because they think the system is stable. They buy it because they can smell smoke in the walls. The math does not require a prediction. It only requires arithmetic. The U.S. national debt is growing at approximately $7.2 billion per day. Net interest on that debt is projected to consume nearly 14% of all federal spending in fiscal year 2026, according to CBO forecasts. That percentage is projected to rise to 14.5% by 2028, and it does not account for any new war spending or emergency stimulus. This is the minimum payment trap. The government is making minimum payments on a credit card it cannot cut up. The balance never goes down. The interest keeps compounding. And now the interest rate environment that allowed this to feel manageable is under threat from an oil shock that is pushing inflation expectations higher. The CBO's long-term projections show debt held by the public rising from 100% of GDP today to 175% of GDP by 2056. But here is the number that matters most. The CBO projects the average interest rate paid on the national debt could exceed the economic growth rate starting in fiscal year 2031. When interest costs grow faster than the economy itself, you enter what economists call a debt spiral, where interest payments increase borrowing raises interest costs, and rising interest costs further depress growth. That is not a forecast. That is compound arithmetic applied to a government balance sheet. And now overlay the oil shock. The EIA projects that even if the conflict does not persist past April, petroleum product prices will remain elevated through Q2 2026, with retail gasoline peaking near $4.30 per gallon and diesel above $5.80 per gallon as a monthly average. Higher energy costs feed directly into transportation, manufacturing, and food prices. That pushes inflation higher. Higher inflation keeps the Fed frozen. A frozen Fed means rates stay elevated. Elevated rates mean the debt servicing cost keeps compounding. Think of it as an ice cube left on a countertop. It does not shatter. It does not explode. It melts slowly, silently, without a single dramatic moment. You do not notice the damage until the surface it was sitting on is soaked. The only question is speed. The direction was determined by the arithmetic long before the first missile struck Iran. October 1973. The Yom Kippur War. Egypt and Syria attack Israel. The United States provides emergency military aid. In response, Arab members of OPEC impose an oil embargo on the United States and its allies. In roughly 4 months, the price of crude oil rose from $2.90 per barrel to $11.65 per barrel, a 300% increase. The S&P 500 fell more than 40% from its January 1973 peak. Inflation surged above 9%. Unemployment climbed from 4.6% to 9% by May 1975. The Federal Reserve raised its benchmark rate from 5.75% to 12% and still could not contain prices. The result was stagflation, a word that is now appearing in headlines with increasing frequency. It took 6 years for the stock market to return to its pre-embargo level. 6 years. Now compare the structural conditions. In 1973, the oil embargo removed approximately 4.5 million barrels per day from global supply. In 2026, the Strait of Hormuz closure has disrupted the flow of approximately 20 million barrels per day, more than 4 times the 1973 shock. In 1973, U.S. national debt was approximately $458 billion, or roughly 32% of GDP. Today it is $39 trillion, over 100% of GDP. In 1973, the Federal Reserve had room to raise rates aggressively without facing a sovereign debt crisis. Today, every 25 basis point increase adds billions in annual interest payments to a government already spending over $1 trillion a year just to service its existing obligations. In 1973, the U.S. imported the vast majority of its oil. Today, the U.S. is a net petroleum exporter, which does provide a partial buffer. But the global pricing mechanism means domestic consumers still pay global prices. And U.S. trading partners in Europe and Asia, economies that purchase American goods and hold American debt, have no such buffer. Germany, the UK, and Italy face the highest recession exposure in Europe from this shock. The 1973 embargo lasted 5 months. The Strait of Hormuz has been disrupted for 51 days, with no resolution in sight and a ceasefire expiring in 48 hours. Every comparable variable is more extreme today. The oil shock is larger. The debt is heavier. The Fed has less room. The numbers sit there quietly, asking the same question the market asked in 1973. Here is where the mechanism separates 2 kinds of actors. On April 10, 2026, the University of Michigan released its consumer sentiment reading of 47.6, the lowest in the survey's 74-year history. The American consumer was the most pessimistic they had ever been measured. Retail investor participation in equities had collapsed to the 10th percentile, according to J.P. Morgan data. The average investor had pulled back. Then the ceasefire was announced on April 7th. The S&P 500 surged 10% in roughly 10 trading days. And by April 17th, J.P. Morgan's flow data showed retail buying activity had surged back to the 55th percentile. The retail investor sold during the fear, then bought back at the top of the relief rally, arrived after the move was already made. Now look at what the institutional side was doing. During Q1 2026, while retail was pulling out, central banks globally were accumulating gold at an accelerated pace. China added to its reserves for the 16th consecutive month. The People's Bank of China's gold holdings reached an all-time high. Chinese retail gold imports surged 123% year-over-year in January and February 2026, even at record prices. While Western gold ETFs posted outflows of over $12.7 billion in the first 4 weeks of March, Chinese gold funds posted net inflows of $1.1 billion. Mainland China gold ETF inflows reached $8.1 billion year-to-date, even as Western investors were selling. The institutional player was not watching the ceasefire headlines. The institutional player was watching the debt math, the oil supply structure, and the Fed's shrinking set of options. And that player was buying the mechanism: hard assets, physical gold, commodity exposure, while the retail investor was chasing green candles on a stock chart. Nobody is telling you which category to be in. The data simply shows what each was doing, when they were doing it, and what the structural math suggests comes next. Before we get to the signals, tell us in the comments, when the S&P hit its new high last week, did you feel relief, or did something in your gut tell you the numbers did not match the reality you see at the gas pump? No predictions? No advice? 3 instruments on the dashboard. You can check them yourself. The direction tells you where the mechanism is pointing. Signal 1, the Brent WTI spread. This measures the gap between the global benchmark oil price and the U.S. domestic benchmark. When the Strait of Hormuz is disrupted, global oil becomes scarcer and more expensive relative to U.S. supply. The spread peaked at $25 per barrel on March 31, 2026, the highest in over 5 years per the EIA. As of mid-April, it remains elevated around $7 to $10 per barrel. If this spread stays wide or widens further, it signals that the global supply disruption is not resolved, regardless of what ceasefire headlines say. If it compresses back toward $3 to $5, the physical oil market is confirming that flows are normalizing. You can track this daily on the EIA website or any major commodity data platform. Signal 2. The University of Michigan 1-year inflation expectations. This measures what American consumers expect prices to do over the next 12 months. In April 2026, this reading hit 4.8%, up a full percentage point from March, and the largest one-month jump the survey has recorded. This is the number the Federal Reserve watches to determine whether inflation expectations are becoming unanchored. If this reading stays above 4% or climbs higher, it signals that the oil shock is embedding itself into consumer psychology, making it harder for the Fed to cut rates and easier for inflation to become self-reinforcing. The University of Michigan publishes this data monthly, publicly accessible on the Federal Reserve Bank of St. Louis Fed database under the series code MICH. Signal 3. The federal funds rate versus CBO projected growth rate. The CBO projects the average interest rate on the national debt could exceed the GDP growth rate by fiscal year 2031. But this timeline accelerates if the Fed is forced to hold or raise rates due to persistent inflation. Track the effective federal funds rate, Fed series code Fed funds, against the CBO's real GDP growth projections, updated in their budget and economic outlook reports. When the cost of money exceeds the growth of the economy, the debt spiral math activates. That crossing is the structural event. The direction of these two lines tells you how fast the mechanism is moving. A war disrupted the single most important energy choke point on the planet. Oil prices surged 90% in 1 quarter, the largest inflation-adjusted spike in nearly 4 decades. The Federal Reserve, already unable to cut without fueling inflation, is now unable to raise without detonating $39 trillion in compounding sovereign debt. Consumer sentiment has hit its lowest point in 74 years of measurement, and the stock market just set a new all-time high on a ceasefire that is not held. Picture a dam with hairline cracks running through the concrete. Each crack, the oil shock, the inflation spike, the debt math, the Fed's paralysis, is manageable on its own. Together, they form a structural pattern. The water does not wait for permission. It finds the weakest point, and it moves. The market is not wrong because it rallied. The market is early or late, depending on which side of the mechanism you're standing on. The math does not negotiate, it compounds.